Hello, everyone. I'm Russ,
And I'm Giles.
and we are the Morrison Mortgage Team. And as you may know, today the prime rate has increased by another 0.25%, 25 basis points from 6.45% to 6.7. So now what happens? Where do we go from here? Giles.
Yeah, so after today's rate change or rate announcement by the Bank of Canada, we were looking for what the statement would be as well as a factor in helping the market predict what they're going to do next. So the accompanying statements essentially said, we will hold rates at this level, but be aware if inflation doesn't keep decreasing, if inflation changes and starts going up again, we are open to further rate increases.
And that's it. And that's exactly what we're expecting, is that we're going to watch rates and just see what happens. Now, the market has responded, and economists have said that we may see some rate cuts coming in October. So, but this is to be determined, of course, and we don't know until we get there. Now, another thing that also has happened is, in response to the Bank of Canada increasing rates, is that the bond yields have started to come down because they're expecting these rate decreases to eventually happen later this year, early next year. So the bond yields have all started to fall. So that means that the fixed rates will be getting better eventually, or over the coming weeks or months, as there will be a trend of the fixed rates going down. So if the fixed rates go down, Giles, are there opportunities for people, and maybe what are the opportunities if the fixed rates begin to come down?
Yeah, so some of the opportunities, the key thing is when you're looking into a fixed rate is how long will you have that rate for, and over the long term will it be beneficial to have this rate? So some I guess options that people may be interested in right now are shorter term fixed rates. So if you're in a variable and your payments have increased significantly, there may be 2 or 3 year fixed terms. Some lenders have come out with some promotions for 3 year fixed terms, for example, that aren't the regular 5 years, but maybe a shorter term solution where you can have a lower rate now and then be more flexible, as and when, as expected, if the rates are lower, to then kind of go into a lower rate.
Yeah, and that's exactly it. Like, if we took a 5-year term right now, because those rates are going to be coming down, and they have, is that the challenge we have is that because we're expecting rates to be lower in the next couple of years, is if you sign a 5-year term at, say, 5%, we know eventually that you're going to be locked into that. There's a large penalty to get out. So right now it's becoming more popular is like a 2 and 3 year fixed term to get through the high rate period, to have some stability, and then we look at things in 2 years from now. So that's kind of what we're expecting, or we're recommending at this point, is if you're in a variable where the payments are quite high, we can potentially bring those down for you. Okay, so that's something. As the bond yields begin to fall and the rates fall on the fixed side, there are some opportunities which we'll keep you posted on. And then lastly is, if anyone is having any challenges with payments, with rates, anything like that, please reach out so we can help guide you through that. One last thing is, 2 good notes, is that inflation is coming down. So the rate tightening cycle is working. And on the housing side, prices are decreasing still. We'll probably see them bottom out. And there is the expectation that once we hit a spring market, or even later this year, that those should rebound a bit. So 2 positive notes. We're getting through all this. If you need something, please reach out. That is it for now. And have a great day, and Happy New Year to everyone for 2023.
Thanks.